Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, it's another busy week at Retire Smart, another successful round of estate planning workshops.
Yeah, absolutely. The classroom was full again a couple of nights, and these things keep picking up steam. And it's great because these are open not only to our clients who find a lot of value in them, just getting educated on all the areas, from Medicare to estate planning to how your insurance works. I mean, we have a myriad of classes. We have a new one on real estate coming out soon. So we've gotten all these great educational events, and people just the feedback is great. But it's really great because sometimes we get introduced to a lot of folks that come right from the radio show and attend these programs, and the estate planning was no exception. A lot of people got some great information, and just so every time we do this, folks, we have an estate planning attorney present with one of our own advisors who actually is has a law degree as well, and they really do a great job. And we got some classes coming up here next week. We'll talk about here later on.
Yeah, we've got one on Medicare. Dustin Galvan will be in the next segment of the show to talk more about that in detail. Also, David, Retire Smart sponsors a lot of charitable causes, and I know one near and dear to the hearts of you and your wife, Melissa. The Assure Women's Center annual banquet was this past week. Retire Smart was a major corporate sponsor. Oh my goodness, 2,000 plus people packing the room. That's always one of the most awesome events in the
It
calendar
really
year
is.
in
It's an
Omaha.
amazing event that happens, and they continue to grow it, and they bring in great speakers. And Tim Tebow's mom was here, and so that was great. And our Babylon Bee founder, who's fun to watch and
That
follow
was
on
a nice
Twitter.
little
Yeah,
change of pace. That was
yeah.
fun.
So a little different, and but it is. It's a little bit of a who's who in the Omaha scene, if you will, that attends this every year. So it's always fun to chat and say hi to so many different people.
Retire Smart is also a major corporate sponsor of something that is becoming one of the big annual events in Omaha, David, every year. This is the Patriotic Parade and Concert Memorial Day weekend, Saturday, May 27th at 10 a.m. It's downtown at the refurbished Jean Leahy Mall. This is Bill and Yvonne Williams. These are the people that organized the honor flights a few years ago to get World War II veterans out to Washington, D.C. to see the new World War II memorial, what was then the new memorial out there. And this is catching on. It's led by Gold Star families, family who have lost someone in military service, but it's also blossomed into this giant celebration of America.
It is, and it's a great weekend to have it, Memorial Day weekend, to pull these things off and really just have people have pride again. It's sad some of the results in recent surveys. When you survey those under 30 years of age, Chip, less than 24% of them believe that they are patriotic, and that's just not the way it needs to be, or the way it should be, or the way it was. And so having events like this, going back to having a little pride in your country, and celebrating what we are. We are still the greatest nation on earth by a long country mile, in my opinion. You have freedoms here you don't have otherwise, and you have the freedom to disagree with people publicly. You can speak out, and sometimes people don't understand or take for granted just how special the way our country has been formed and what we are allowed to do. You're allowed to prosper if you want to put your head down and work hard, etc. And so this is just a joyful celebration to all those that have made that possible, who protect our right to serve, and these families that have had the ultimate sacrifice given. So it's just an honor to help sponsor it.
Did I tell you one of our clients, Sharon Orduña, who is herself a veteran, is going to join yours truly at the microphone to call that parade? So that should be fun.
This should be fun. So I got to go back and get the audio. I'll be on the standing on the street, so I don't know if I'll see it or whatever or hear it, but that should be fun, and it should be a great day. But anyway, lots of good stuff going on. Now we've got another event coming up actually before that weekend, right? The
May
Saturday
20th.
before, yeah.
May
So
20th is Shred Day. Tell people what Shred Day is all about.
so shred days, folks, is listen, identity theft in this digital world is a very real thing. And one of the ways you can protect yourself is to get rid of those old bank statements in the basement or in the garage, or, you have all this sensitive information, tax returns. And we chat with clients and they've got stuff in the 70s and 80s. Something. I'm like, why are you keeping this? You can scan it and digitally protect it on a locked drive if you want, but you shouldn't have loose papers around. So we offer the opportunity every year, kind of once tax season is wound down, so that you can shred documents if you'd like, old bank statements, credit card statements, anything you think that is sensitive. We will complimentary let you bring it here, up to 2 big banker boxes full of stuff. And you don't have to be a client, folks. This is open to anybody listening. That's going to be Saturday, May 20th from 9 a.m. to 11 a.m. But you do have to register. We have over 100 folks already in the queue because we have to make sure we're prepared to handle that with the shred company that we have on site. And you can actually watch your stuff get shredded right in front of your eyes, et cetera. So anyway, it's a really popular event. We've done it. I've done this for years, every year. And you just so you know, nothing needs to be retained over 7 years. You won't get asked for data more than that. So get rid of those old sensitive
Two
documents.
bankers boxes, right? Basically 2 feet by 1 feet by 1 foot, a couple
Yep.
of bankers boxes full of statements. 402-369-7777. As David said, we do need you to call and let us know that you're coming, so we're prepared. 402-369-7777. Well, David, we always start off by diving into the news. You were the news this past week. You did a turn on Fox Business with Maria Bartiromo, her Mornings with Maria, I think the show is called. And what jumped out at me was the graphic that was showing for most of the time that you were talking on the screen was that more than half of Americans 65 and over have less than $100,000 saved for retirement. David, we have some work to do.
We do, and it's there's a retirement crisis in America. There really is, because most people don't have enough money saved to adequately fund their retirement in reality, right? And now that's typically not the clients we're working with. That's the reality there. But the reality is this is it. So one of the premises we talked about on that show is we gave a couple of tips, or when I was on Maria's show, is I gave her a couple of tips on just what things people could be doing right now, potentially de-risking your portfolio in volatile times. The recession we believe is imminent. But also we got onto the topic. They asked about, hey, what if we had to push back the age of Social Security? And I kind of made a reference. I think I caught her off guard to France and what's going on over there. They just pushed it back from 62. You retire full pension ability over there to 64, and they burned the streets down.
There's great unrest over that.
And so people don't like actually knowing this. So some of the data points I gave out is the average Generation Z. These are the younger folks. These are basically 24 and under. Their first job, Chip. Their first job is almost 5 years later when they take their first job than baby boomers did. In other words, I took my first W-2 job at 14 years of age, right? And actually, I mean, I worked for my dad a little before that, but actually got a paycheck from a company when I was 14.
Right.
Very common in Generation X and baby boomers that we started working somewhere around our mid to late teens, right? And especially by the time you had a driver's license, 15, 16, depending on what state you lived in. Today, the average kid doesn't get their first job until they're in their 20s. Their first job, period. I mean, they don't go work at the ice cream
in
shop.
high school or anything.
The summer jobs don't happen like they used to. Now, some do. It's not everybody. So the point I was making is if we are living about 5 years longer than the last time we made the actuarial change on Social Security, which was 40 years ago, 1983. That's when we took full retirement age from 65 and slowly moved it just 2 years, but made the program solvent for about another 50 years. If we were to do something similar now, so we don't have to raise taxes because that's the other side of the coin. They can easily raise taxes. But if we were to do that, you could make the program solvent all the way up to 2095. And the reason it would be fair to do that is those that are younger than us are living, the average life expectancy in America has moved almost 6 years in that 40-year period. So instead of living to 72, the average American is now living to over 78 years of age.
That'll blow up your actuarial tables.
And that they're not starting to pay into the system to 5 years later. They're not actually really paying more because that's the fallacy that, oh, you're going to make these younger workers pay the bills. No, everybody has to pay their part into it. So it can be solved. And we talk about this, by the way, in our Social Security class that we just had recently with Sean Swanson. And again, if you want to come to that, sign up for it. But anyway, this is why it is so important to understand how to have a holistic view of your financial plan and understand all these data points that we talk about here on the show each week.
David, since last we visited, the Fed did what you predicted it would do. It raised interest rates 25 basis points, a quarter point. What does that mean, and is the Fed done?
So the Fed is most likely done because this week we just got CPI out. So CPI came in at 4.9% on Wednesday morning, basically at expectations or a tenth below. However, core inflation stayed at 5.5. But the point is the Fed funds rate is now over 5% and inflation is at 4.9. So the Fed fund rate, for the first time in a long time, is above the actual CPI inflation number. That is their goal, to get that to happen. So now you can see them could pause, and we should see inflation start to run off. In fact, we talked about it at our State of the Market for our clients. we're going to be worried later in this year about disinflation or deflation because it can be scary if it's not unwound correctly. It could spiral us into a very deep economic recession. But anyway, so prices are starting to come down, but they're still sticky in a lot of areas. And then there's problems here because as they raise rates more, the banks are still in trouble. You're creating havoc for the banks by raising these rates in the short term because they have these long bonds that are worth less money, and people keep pulling money out of the banks, and that run is not going to stop anytime soon.
Jobs, David, the labor market. I want to hit you with two headlines and see if you can reconcile them because in my brain, I can't. First one is from Fox News, Fox Business. U.S. job growth beats expectations in April as economy adds 250,000 new positions. Right? That sounds pretty good. But then the next one from CNBC says job openings fell more than expected in March to lowest level in nearly 2 years. In my mind, those sound irreconcilable. Please sort that out.
Okay, a lot of problems with the data now, and that's coming to light. You and I talked about this about a year ago, where economists were calling out the Bureau of Labor Statistics on some of the job numbers they were giving, and they weren't jiving. Well, we're seeing this now as we go through and get to the real data. So, as you mentioned, we had 253,000 jobs in this last report. The expectation was about 180,000. So that's a beat by 70,000 jobs, or a 40%
It's 40%
upside,
higher
right?
than expected.
Well, they revised in the same release 3 minutes later, quietly. They knocked off 190,000 jobs from the previous 2 months that they said happened that didn't happen. So,
Okay.
so the job growth was negative, and then we lost over 500,000 jobs in the job openings. We had like almost 10 million openings in America, and that got cut to about 9.3 million. And it's being cut, so the job offerings are going away. The job cuts are still happening. We're still getting headlines every day of companies cutting their workforce. And then you got companies that are in this frothy economy. We're doing well, like Airbnb. They just missed mightily. Their stock was down Wednesday morning after they reported a bad miss by almost 20%. Before the stock even opened. And the economy, again, it's going the wrong way, and the job data is telling us this. Now, here's my call out to anybody that works for the federal government. They keep trying to tell us that we added 4 million jobs last year, more than we had prior, yet the IRS receipts are 30% less. And how's that possible?
30% less.
Yeah. So
Yeah.
so that tells you where the job numbers can't be real, right? It's very simple
You'd see
math. I
more
mean, so
revenue.
once you
Yeah.
dig in and understand, and so BLS, the Bureau of Labor Statistics, basically kind of admitted, well, we were estimating on some
We're
of these
gonna have to
numbers.
start deleting the L from that acronym if they
Yeah.
keep up. It's so annoying with people moving the goalposts. It's a moving target. Just give me the facts anyway,
Yep.
so I know what the reality is. Well, David, so maybe this leads us to this CNBC headline: 70% of Americans are feeling financially stressed. That's according to a CNBC survey. Higher expenses, the article says, more debt. Nobody can afford to keep an emergency fund going. Women feeling it more than men. So the reality for those of us on the ground living our lives is not as rosy as some of these indicators
I,
might suggest.
and this is so true right now. And I actually talked to a couple of ladies. I was blessed to be a keynote speaker this past week at for the women of UNMC. They had their annual conference, and they asked me to come in and be one of the guest speakers. And we just talked about retirement in general and what the things that you need to be looking out for. But the stress, and I brought that article up, the stress that women are feeling is higher. Why? Because let's face it, if you're married, a lot of times the wife is the one responsible for handling the household duties, the shopping, balancing the checkbook, in the traditional sense, not to be sexist or anything, but they just handled it, and so the husband would leave and just go do what he did and came home, and she's having to handle the brunt of the work. And then today's society, we expect that person also to be a career person, and we have most incomes need to be dual income families today. And so there's still that burden hasn't been shifted back to the male in a lot of these relationships. So they unduly feel the stress. And then, of course, the problem is if they're single women, they feel the pressure that they don't have a counterpart to help them with. And then, unfortunately, women do earn less in their lifetime than men, not because they're paid differently. Now, there's some data to prove this, but because they take time off of the workforce, childbearing years, things like that. So there's a lot of reasons why women are going to feel more stress, and that's why one of the women events we do with our female advisor, Dane Lawyer, is so helpful. The Inspiring Women class she teaches. But anyway, yeah, in a nutshell, folks, people are not feeling the love right now economically, and it's scary times from the political environment we find ourselves in, from the the economic environment we find ourselves in, and then just what's coming in our local economy. So just be prepared, have a plan. Don't sit on your hands. Take proactive action to get at least an idea of where you stand and where you could be, and we call that a report card.
Let's repeat that. Be prepared, have a plan. That's where we can help. The report card that David just referenced is a comprehensive review of your financial situation. No charge, no obligation. We'll look at everything. Maybe you're in good shape. Maybe you don't need to make any changes. Maybe you do need to make some changes, especially in these unprecedented economic times. We can help you navigate those turbulent waters. 402 369 7777 for a complimentary report card. 402 369 7777. Up next, from the halls of Montezuma to the fourth floor of the Valmont Plaza. He was a United States Marine. He's now a financial advisor at Retire Smart. We check in with financial advisor Dustin Galvan next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Our special guest this week was in the Marine Corps. His mission now is to help people optimize their quality of life in retirement. David, please introduce our special guest.
Yes, thank you, Chip. And in the studio again this week is our ex-Marine, ex-big retail broker, and now a fiduciary-based financial planner here at Retire Smart. He's been with us for a while now, Mr. Dustin Galvan. Dustin, thank you so much for taking time, dropping in this week.
Yeah, thanks, David.
We've got one of our most popular classes that you have taken over the duties from me in helping teach and facilitate at the Midwest Learning Center, and that is, of course, the ABCs of Medicare. There's four primary parts with Medicare, and unfortunately, most people are not educated on this throughout our working career, even though we pay taxes on it every single year, right? On this benefit that we're waiting to get. And then people sometimes are surprised when they walk in and find out just how much money they got to spend out of pocket for this allegedly covered healthcare benefit, right?
Yeah, no, a lot of people are surprised when it comes to the different segments you need when it's just traditional Medicare. We all know that Medicare Part A you actually pay into during your working careers.
No, we all don't know that. You know that, but I'm going to tell you, people don't know this stuff, and so that's what's really, really critical. Now, Part A is what he's talking about is of course for
Hospital-only use.
yeah, so that's when you're actually admitted to the hospital. But the real part of Medicare you're going to want to be accessing the most is called Medicare
Part B.
Part B, right? And so you've got good news on Part B, though, right?
Yeah, so Medicare Part B, it actually went down this year. This year for 2023.
And by saying going down, you're talking about what you actually pay, a monthly premium. The price actually went down during this inflationary environment. That's fantastic news for our senior citizens.
Yep, yeah, and the Medicare Part B premium monthly for most people, and I say most because you can possibly pay more depending on income that you have in retirement, is $164.90 this year. Last year in 2022, it was $170.10 a month. So it has gone down a little bit. One other thing that has gone down as well is the Part B deductible that you'll have to pay actually went down $7 this year compared to last year as
So
well.
that's the first couple $100 or something like that out of pocket, right?
Correct.
So I found an article from AARP, not my favorite organization because I don't think they always advocate correctly for their actual constituents. That's just my humble opinion, of course. But in this article, they laid out a lot of changes that took place from 2022 to 2023, and we have some of those changes yet to be implemented, but they're going to be implemented here for the second half of this year, right?
Correct. One of the first ones that starts is July 1st. For anyone that is a diabetic and taking insulin, they are going to actually have a copay cap of $35 that you'll have to pay when you're using insulin, and also they will not have the deductible either there anymore.
So that's huge news because those that sometimes get thrown into what's known as the donut hole. Now, what we're talking about here is prescription drug coverage. That is Medicare Part D, and there's a lot of changes coming here too. Now, just so we're clear, though, Medicare Part D has only been around not even 20 years yet. So we're coming up next year will be the 20th year that this was enacted into law. This came under W. Bush Jr., basically. But it is still, to this day, the only major launch of any federal program that has still come under budget. And here we are 2 decades in. So that is an incredible feat. I'm a little nervous about that, though, because of some of these changes that are coming, right? So drug companies are now who partnered with the government to pay for part of these drugs. Well, now the government is going to start to negotiate in a different facet than they've done in the past, right?
Yeah, so Medicare Part D, they're going to start to negotiate these drug prices. Now it's going to roll out in segments, so the first 10 are going to happen here pretty soon. It won't take effect till 2026, but at least they're going to start to negotiate with some of these drug companies. There's also a law in place as well to make sure that these medical, companies or pharmaceutical companies cannot raise the price on drugs more than
So
the
here's
inflation
the
rate.
problem with this. So the idea behind this that they're going to negotiate sounds on the front end like it's a great deal. Oh, we're going to hold down prices. Where's that money going to come from? Right? It's going to come from somewhere else. And what it's going to do is the government's going to have to pay more on their part to get this done, and then they're going to end up having to raise taxation issues and other issues eventually down the road. And that's what the actuarial tables tell us. The CBO tells us information. So while there is good news on the front end, I would just, as always, be cautiously optimistic about, unfortunately, when the government shows up, hey, we're from the government, we're here to help. That usually doesn't bode well for the consumer in the end on cost and expenditures. But overall, what you're saying is there's some pretty good news out there on some of these changes, specifically for diabetics in particular. But let's shift gears here for a minute, Dustin, and let's just talk about, you briefly mentioned earlier, when people have higher incomes in retirement, a lot of people are not aware there's not one but two tax penalties, and there's 5 penalty lines, so that could be 10 tax penalties every year. Potentially, some retirees could be paying, and we're talking $1,000 a month in some cases for married couples, and they're shocked. I mean, I remember retiring somebody here locally of a very large company everybody would know, and they advertise on TV, and they're kind of based here, and was like, our Medicare is costing us, $1,200 each a month. Yeah, well, let me explain why, and so let's explain kind of how Medicare Part B, that is, again, everything outside the hospital. That's when you go to the doctor, you get your screenings or have outpatient procedures. That's covered under B, and that's what you pay that monthly premium for. But that monthly premium has a tax penalty that goes on top of it if your income is too high, right?
Yeah, exactly, David. So what you're talking about is the two penalties that are there. It's for Medicare Part B and Part D. This has to do with the income that you have coming in during retirement. Unfortunately, a lot of people think, hey, when I'm retired, I'll have less income. My taxes will be lower. Medicare will be manageable. That's not always the case, especially if you have any sort of pension. And depending on the size of your IRA, that required minimum distribution that will come out to you at 73 or 75, depending on your date of birth, can really push you through those brackets.
And this is if you got a 403B, a 457, a pension, an IRA, a 401k, any of these things you've been kicking the can down there on the tax bill. Not only are you going to have to pay income tax at higher rates in less than 3 years, that's the law, but then you're likely going to, because these will push you into a higher income bracket, start to pay these penalties, and then you're stuck paying them basically for the rest of your life. Do they have to take it, or can they pre-plan for this?
No, this is something that, you can pre-plan for as long as you come in and meet with one of our advisors here. We'll actually be able to show you the amount of Medicare penalties, if any, that you'll have to pay during retirement.
So the good news is, folks, you can be proactive about this. You could actually put a plan in place before you have to start paying these penalties. And in some cases, we have to recommend clients pay a couple of years of penalties, but it's we call short-term pain for long-term gain. So you can learn about all this, the taxation issues, the 4 components of Medicare, how they work, all the different components, what your out-of-pocket costs are expected to be. Get some really valuable information while you're here if you attend the next ABCs of Medicare. When is that next class, Dustin?
Yeah, so that next class is May 24th. It's at 6:30, and it's going to be in the Midwest Learning Center. We'll talk a little bit more about things we discussed here today.
All right, so that's 6:30 p.m. on Wednesday, May 24th. But if you want to get registered, you're going to need to give us a call, 402-369-7777. Dustin, we're running out of time here. We talk about there's a lot of holes in Medicare. Speaking of holes, you punched a few holes in one of my walls in my home this week, didn't you?
Yeah, so I figured out I'm better at this job than trying to be a handyman. So,
well, my wife recruited Dustin to be a handyman because I am not one. And so we have this new artwork display. I think it's 36 holes in one piece of drywall. It's pretty interesting. But anyway, if you want to find out more about that, you should attend the class coming up for the ABCs of to Medicare right here at the Midwest Learning Center. Again, 402-369-7777. Again, thanks for stopping by, Dustin. Appreciate your time.
Thanks, David.
All right, Chip, what's next?
Up next, you have questions, David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, the first question regards inflation. I saw a financial news headline saying Nestle has raised prices nearly 10% on items such as Kit Kat and Nescafe. I thought the consensus was that inflation was behind us. Is Nestle exploiting the hype about inflation, or is inflation still more of a factor than some want to admit? David?
So companies are going to move prices because they need to, right? When their input costs are higher, they have to raise the price of the product they're going to sell. So you not only have the price of the inputs from the raw materials that has been up, but there's a lag as that product gets to market. It's about 18 months in food. So inflation has, in fact, peaked, at least in our opinion. And again, we just talked about the data. Inflation was finally under the Fed funds rate, the core number, or the headline number at 4.9 this past month. But that still means we paid 4.9% more than we did a year ago. And that year it was 6.5%. So we're up about 11% in the last 2 years. And this is exactly this. So the companies have delayed. They delayed as long as they could raising their prices, but now they have to go through that cycle, and then a year from now they will reduce the prices. Now, what's really scary is the shrinkflation that we're seeing in the food market. And if you go, and I don't have it with me, but someone just sent me a graph of like 65 food products that are commonly bought, mac and cheese, these other things that we all buy, potato chips, of brands that you would know, and they're the leading brands, and the shrinkflation, how they've simply shrunk the package by up to 15-18% on average, and
So
raise the price slightly.
Or the price might be the same,
Yeah.
but there's less product inside the bag or the box.
So that's what we call sticky inflation, and it hangs around for a while. Housing's still sticky, and we're still seeing it in food, but we are seeing commodities drop. And I've talked to farmers about this. Hey, go get rid of your beans and corn if you've been storing them, because the prices are dropping. We're going into a recession, not here, around the globe as well. So we're seeing these prices drop. So the food inputs are going to go down. But it's going to be 18 months before that shows back up in the grocery store. So, I mean, I'm telling you, I was laughing last night. I was at the store with a friend, and at Walmart, a 12-pack of Coca-Cola was $9.99 for a 12-pack. And I'm like, what? And I don't drink soda, so I don't buy this very often. Now my son's the only one that drinks that kind of product. He used to live in our house, so every once in a while I'd buy it. But I'm like, there's no way I could just stomach that. I remember when it was $2.50 for a 12-pack. But that brings me to the point here. He's asking if Nestle, are they gouging? No. Companies have a responsibility to run profitably. They have to give wage raises to their employees, et cetera. And so they're going to move the margin where they think they can. And this is what Warren Buffett loves, which is, by the way, he loves the aforementioned Coca-Cola. It's a big holding of Berkshire Hathaway because they have pricing power, and they've proven it. You don't stop buying Coke, right? And when I did drink soda, I'm a Coke guy, not a Pepsi guy. I won't drink Pepsi. It's just way too sweet for me. Coke had the burn, what I mean? It was always good with a Philly or a piece of pizza or something. But I gave up soda about 7 years ago. But anyway, so companies have pricing power. They are great investments, just so you know, theoretically, during recessionary time and inflationary times, because they can hold their margins better than other companies. And so that's where understanding how to allocate your portfolio on a risk metric is a pretty good tool. So,
David, the next question is about the stability of banks. At the website Zero Hedge, I read an article saying that half of America's banks are potentially insolvent. That sounds crazy. Do you agree is the question. David, the article says there are something like 4,800 banks in America, 2,400 of them potentially insolvent?
if they had to what we call mark to market, absolutely they'd be insolvent tomorrow. And when I say mark to market, you have to take the assets on your balance sheet and price them where the market says they're priced right here, right now. So like a stock in the market goes up and down, but it's priced every millisecond, right? So you can see what the price and value is. Well, when you have assets on your balance sheet, long-term assets, loans, obligations, you just mark what they're worth, and then you change the markings as those loans get paid off. You change it maybe quarterly or once a year. You don't mark it to the price of the market. So and this is part of what the debacle that happened to banks and financial institutions like Lehman Brothers and Bear Stearns during the crisis of 2008. They instituted this mark-to-market accounting, and so when Bear Stearns sold something at a discount, everybody else on Wall Street had to mark theirs down immediately to that price, and it just created a spiral effect and made one insolvent after the other. What we're talking about today is the balance sheets of these banks, whether it's car loans, whether it's mortgages, whether it's long-term debt, treasuries, corporate debt, wherever they've got the assets with interest rates going up, bond prices go
Down.
down, right? And so those are marked down. And then if you come to the window, so to speak, hey, I want my money out of the bank, they have to sell that asset at a loss currently, and therefore that's exactly right. And there's a Stanford professor backing all this data up that over half the banks are technically insolvent, which is why I don't think the bank run is over, right? And they keep trying to placate you. And then we saw this with J.P. Morgan's, Jamie Dimon from J.P. Morgan. Oh, the crisis is over when they came in and bought the First
First
Republic
Republic.
public, right?
Mhm.
And of course, immediately 2 days later, PacWest and Western Alliance, two other banks, the run happened on them. Now they've tried to stabilize them, but again, it'll exacerbate itself pretty quickly as people realize where they're going to go. I was at a conference with hedge fund analysts last week in Greenwich, Connecticut, and they were talking about the loaning situation and where the delinquencies are really ramping up is in car loans. Imagine that. We've talked about the average car loan is over $600 a month, an insane amount. 14% of all car loans are now delinquent 60 days. That's scary stuff.
Oof,
Yeah.
boy.
And so you're going to walk away from the car. And of course, the used car prices are starting to come down. They went crazy. So now you got a car you owe 20 grand on, it's worth 12 and you owe 20. What are you going to do? Are you going to keep paying the payment?
Right.
No, you're just going
It's
to heck with
over.
it and you're going to walk away from it. So this is going to create a spiral effect. And the largest regional bank that has car loans and it's a very fractured industry. So it's not concentrated in just one area, but Ally Bank is the biggest car loan bank in the country, followed by what's called, I think, the Car Associates Credit Facility, whatever. CACC is the ticker on the second one, and Capital One, I believe, is the third largest. Now, this is just from memory, so I don't have a data in front of me. But but it's very fractured because a lot of banks and credit unions get into car loans, but the defaults are cranking up, and that is going to again put pressure on these banks. In addition to the bonds they have that have created the run on the first several banks that have failed. So again, regional banks are going to continue to get battered, in my humble opinion.
Well, you referenced that Stanford study, and the word that person used was spooky, that it's spooky right now. And the words keep resounding in my head because I asked you a few weeks, it might have even been a couple months ago at the front end of this, are we having a slow motion run on the banks? And you said, well, it's not slow motion. It's just that it's quiet. It's kind of a stealth run. It's not publicized very much, but there's definitely a problem.
Well, in the half a dozen banks that have failed that we know about so far, right, that have gone technically actually failed and been pushed on to someone else through the FDIC receivership program, et cetera, more assets on those banks than the 150 banks that failed during the 08-09 time period. More assets in
Yikes.
just those banks.
Yeah.
And so if the dominoes keep going, you can talk about why the spooky is here. And people are nervous. We get the calls all the time. And you have every right to go take your money out of the bank if that makes you nervous. I'm not saying do it. I'm not advocating that. No one's ever lost any money in an FDIC insured program. The problem with this, Chip, is what are they going to do? They could come out tomorrow and just say, hey, we're going to backstop all deposits. How are they going to pay for that? Right? You are going to be on the hook for that.
That makes me nervous
Yeah.
as a taxpayer.
Absolutely, and you should
Yeah.
be very nervous. So
Yeah.
spooky is a pretty good term here because and we're going to get desperate here, and the current administration may take action. So just be proactive. There is treasury management programs. We offer one. A lot of firms do, where you can put your dollars in U.S. Treasuries, and there's nothing safer. Let's face it. If the Treasury fails, then we got even bigger problems.
This is going to have to be a quick hit, David, but let's see if we can squeeze this in. It's a question about the minimum wage. And I love this because as a former office holder, I'd keep hearing, well, if you care about the people, raise the minimum wage. Well, slow down, sport. All right, here's the question. I hear some political leaders call for raising the minimum wage as the way to help people struggling in these difficult economic times. But doesn't raising the minimum wage do as much harm as it does good to an economy? David.
So I kind of laugh here because I have a niece, my younger brother's daughter, who is different than on the political spectrum than I am. Let's just put it that way for sure. And was this huge advocate during high school. We got to raise minimum wage. We need it to be a living wage, et cetera. She just graduated with her graduate level degree, right? She just got her, she just finished graduate level schooling in healthcare arena, but she's just got her first apartment in a city and, lives a couple hours away from home and just got moved in. My brother's talking about, but I was having a discussion with her and she's like, man, it's wrong for them to keep trying to raise minimum wages because in the reality, I've learned that it just creates those people to have to pay more for their food and more for their, you're understanding it. So politically, people like to use this as banter. I would tell you, I could care less about the minimum wage. In reality, it doesn't work. So you shouldn't have a minimum wage, just so you know, if you follow real economics. But politically, it's not expedient to anybody to say that. And so Make it $50 an hour. Who cares, right? Because everything is going to adjust rather quickly, and you're going to punish though the what people need to understand is the people earning the minimum wage get punished the most when it gets raised, and that's factual because of the inflation that goes through the supply chain when you do it.
Well, not only that, you're a small business owner, and before Retire Smart, you had a series of restaurants. And as an office holder, I would especially have restaurant owners come to me and say, "I just want you to know what happens. I'm running a business, not a charity. If you're going to increase my cost of labor, then if I've got to make a choice between the low skilled adult who really needs the job." Or the high skilled teenager who might just be looking for pocket money, but is a more productive worker. I'm sorry, but I'm going to keep the more productive worker. So the very people that you say you intend to help might be the ones targeted and losing jobs in these scenarios.
You had the CEOs of a lot of fast food companies, Taco Bell, Yum Brands, and Pizza Hut, et cetera, and McDonald's or Burger King, excuse me, all testified before Congress during this would have been 15 years ago. So when we were having an argument on minimum wage way back then, and they were talking about we got to take it to $15 an hour, and they got to explain that when you took it from 4 and change up to 7 and change, that was a pretty big jump. And they said, listen, within 3 to 5 years, you're going to double the price of a value meal. So and here's the way I always say, whatever minimum wages in different states have it, that's about what you pay for a McDonald's Happy Meal or a value meal, right? So that just shows you the inflation. Like, it's $12 to go get a Big Mac meal or whatever, right?
You can't get an economy combo meal for less than $10 basically
and
anywhere.
And so here in Nebraska, minimum wage is still the federal one, which is only 7 and change or whatever it is,
Yeah.
right? But I don't see any employers offering that, right? Because the market is setting it. We have low unemployment here, less than 2%. And so the market sets it. And you can start at a convenience store here. You see it all the time. One of our major chains offering people $15 to $18 an hour to start. Target, Walmart offer those wages. So let the market set the price. But minimum wage punishes the lowest people in the income bracket.
Wages, bank stability, inflation, don't let any of it get you down. Don't let any of that make you panic. Get the report card, 402-369-7777, our complimentary review of your entire financial situation. Maybe you're in good shape. Maybe you need to make some changes. Now is the time to find out. 402-369-7777. No charge, no obligation, a complimentary report card. 402-369-7777. Up next, it has been called Woodstock for Capitalists, the annual Berkshire Hathaway meeting. We'll review that next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, we have to talk about it. A big event, not only in Omaha, but in the whole financial world. The annual conference, the annual meeting of Berkshire Hathaway, Warren Buffett and Charlie Munger presiding. Let me hit you with a couple of headlines from CNBC. Well, one just says, here's a recap of everything that Buffett and Munger said at the meeting. And then there is a story that says the most important thing Warren Buffett said Saturday, and it isn't good news for the country, for the economy. David, dive in and give us your take on the annual Berkshire Fest.
Well, again, they're the companies that they own and participate in. They love the ones that have pricing power, as I mentioned, like Coca-Cola, and they talked about the how quality investments like that have pricing power can maintain them, as quality investments in turbulent times. But in the general economy, they basically, the kind of the real key takeaways Warren Buffett kind of has talked about is, listen, this exceptionally crazy period of excessive spending, all that stimulus money, it's over. It's gone. It's done. It's in the rearview mirror. So that's problem one he talked about, right? In other words, the consumer is tapped out. And we've talked about that recently, Chip, on, credit card debt is now over $1 trillion for the first time in history. Record credit card debt and record average interest rate on those credit card balances. Student loan payments are about to resume here this summer for a lot of people that have had 3-year reprieve without paying it. And, of course, are they ready and budgeted for that? That is creating headwinds coming up. Then Warren talked about all the small businesses that had to scramble to stay afloat during this weird period, right? This is a strange period where we went through where demand went up on a lot of products people didn't expect. And so we had the supply chain disruptions, right, from COVID. And then we had companies that couldn't get inventory. And his own company, where they do the meeting, or at least where they do some of the interviews with Becky Quick on CNBC, at Nebraska Furniture Mart, right? They used the Mrs. B's location there.
Right.
My wife and I shop there. It's great stuff. But they couldn't get us product in. I bought furniture for my patio during that period, and it was 9 months before I got it, right?
Oh, I have numerous relatives and friends with the
and,
same
and
story.
appliances they
Yeah.
couldn't sell, and they were trying to stay afloat. So they scrambled, they doubled and tripled down their orders because they had to make sure they got inventory. Well, now it's just flipped, and he talked about the inventory buildup all across America in these
Now all
businesses.
the goods are arriving, but the demand is down.
Demand is down, and
Oh, my
people's credit
goodness.
is being taken away from the
Yeah.
banking issues we just talked about earlier. So we're having almost the perfect storm of credit is being tightened, demand is dropping, inflation is finally dropping, which means wages are going to start to drop, right? The wage growth we had. And then we've seen jobs being pulled from the market and layoffs increasing. All this leads to bad outcomes. So he was forewarning and foretelling as best he could without sounding, too ugly, if you will. It's not going to be a good economy here in the next year or so. And I love it because they tell you right what they really think. And Charlie Munger, who's still sharp as a tack. I mean, he's a little slower in the speech there, and he'll be 100 on his next birthday. And Charlie's words of wisdom are amazing too. And of course, Charlie talked a little bit about crypto and how he still thinks how many people are getting fooled by crypto assets and why they have zero business in looking at those things. And it was funny some of the call outs they got there. But look, the general message is it doesn't look good out there, Chip, and it's probably going to get ugly for a lot of people.
One of the issues that came up, David, was reserve currency, the U.S. dollar as a reserve currency of the world. Would you define for people, first of all, what that means, and then what Buffett had to say about that?
Well, absolutely. Let's face it. A lot of people, and we have clients call us, right? Because they just get rhetoric out there in the news media and on social media. The dollar, the de-dollarization, folks, that's just camouflage for there's not enough dollars, okay? The dollar is not, repeat, is not going away as the reserve currency of the world. 62% of all transactions on the globe still happen in our currency. That is massive, right? I mean, massive amount of transactions in our currency. And yes, people are starting to trade goods and services, oil in particular. People worry about that in other currencies. But who is going to take over as the world currency if the dollar's not it, Chip? I always ask people this when they tell me, oh, the dollar's going away. Okay, what would replace it?
Well, China probably wants to, but I don't know that that's realistic.
Impossible. It's a communist country, not a free country, and they don't practice real capitalism. They do not let their currency float against other currencies. China sets the price. They just wake up, you know what? We're going to devalue our currency to help our exports, or we're going to increase the value of our currency because it's going to help us with imports. So they change the price based on what they want. They do not let it float like our dollar floats against all the other currencies, right? So supply and demand of dollars, what sets it. And we still have the most stable currency, and we still have the biggest economy in the world. Even though you have two countries out there with well over 1.3 billion people each, China and India now, right? And India is now the largest country in the world population-wise, and that is a capitalistic country that speaks English and has rule of law, and that economy is going to do nothing but explode. Now, the scary part is how big they are, is how much corruption will be within that explosion, but nonetheless, that will hugely benefit world GDP, right? China, on the other hand, had a 4-decade policy of single children, right? That produced, so unfortunately, they only kept male children. It was horrible, but now you have an entire 2 generations that do not have mates. Right? They have no mate. And so their population decrease is accelerating at a rate that's incredible. Italy, by the way, just had the lowest birth rate in their history as a country reported this week. And so we're seeing a depopulation of the globe, and it's happening rather quickly. That is a problem for growth around the world as well. So, but anyway, the dollar is not going away. The dollar's actually getting stronger. And again, I have to explain that. Now, it doesn't mean we're going to keep spending money. We got the debt limit we'll be talking about probably next week because it's not going away, and what that means for the dollar near term. But gold can be an asset that people can look at. But tactically, Chip, it's not, don't put all your money under the pillow in gold because you have to time it perfect to sell it. When we manage portfolios, are happy to use assets like that to help us understand those times. But anyway, yeah, so the dollar is not going away. And Buffett, who's a pretty smart fellow, I would think most people would agree, agrees with what I just said. So, and he said that as such. There's no way it's going away.
A quick 30-second point here, David, because Buffett was talking about Apple. He was complimenting it on being a successful business. He was talking about how big it's getting. You mentioned that Apple and Microsoft together, it's what, like 15% of the market right now?
Yeah, Apple's
Should
market
we
cap
be
became
worried about that?
absolutely, and Buffett, of course, they own a good chunk of Apple, about 5% or so. And it's just been a better company than they could find elsewhere, and that's why they leave their money. It's a smart decision, but it is now 8% of the S&P 500 all by itself, and that combined with Microsoft, as I said, make up over 15%. I talked about the team meeting. That's scary because if those two have hard times, if they falter in any way and drop just say 10% in value, what that will do to the index value and the portfolio values of our listeners is incredibly powerful. Now, I want to touch on one last topic that Charlie Munger talked about, AI, right? I've been talking about
He
this
doesn't have much use for that, does he?
yeah. Yeah. Well, let me get the quote here. He basically said, I like old-fashioned intelligence. I think that intelligence works pretty good over artificial intelligence. Now, what I say is AI stands for is artificial inflation of a stock price. When you have nothing else to do,
Ah,
very similar to 25 years
okay.
ago, you would just add the word .com to your earnings call. Oh, well, we're going to open a website. That's what you should say. We're going to have this new website, and the stock would rebound. So AI has been mentioned in all these earnings calls. Wendy's just announced they have AI at their drive-through. It's not AI. It's just an automated text service back and forth, pre-programmed. But they're
Yeah.
everybody's stealing the term AI because it sounds awesome. Don't be fooled. Find out how much risk you have in your portfolio. A report card's a great way to do that. I know we're out of time, Jim.
Well, that's all right. We've got the report card on the menu this week, or a tax planning guide for either one of those. 402-369-7777. Don't forget about Shred Day, Saturday morning, May 20th, 9 to 11. But we need to hear from you. We need to know you're coming. 402-369-7777. The ABCs of Medicare. You heard Dustin Galvan. He'll be presenting Wednesday night, May 24th. 6:30 right here at the Midwest Learning Center at Retire Smart, but you need to call to register for that as well. Say it with me, friends, 402-369-7777. And then finally, put it on your calendar, the parade on May 27th, Saturday morning, May 27th, 10 a.m., downtown Omaha, the Patriotic Parade and Concert. David, bring us home.
Have a blessed and prosperous week. We'll see you at one of these upcoming events.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.